welcome to Sectors Up Close. I'm Elena Casas. Today we're focusing on China, and my guest is Marcelo Carvalho, Global Head of Emerging Market Research at BNP Paribas. China remains committed to its so-called zero-COVID strategy, hitting back against the head of the World Health Organization this week when he described the increasingly painful policy as unsustainable. Hundreds of millions of people across dozens of cities are in some form of lockdown, most severely in Shanghai, where residents have been largely banned from leaving their homes for 6 weeks. Authorities say half the city recorded 0 cases in the last 3 days, but there is no sign of a let-up in restrictions. With factory workers and consumers stuck at home, China's export growth has slowed to its weakest in almost 2 years, with major manufacturers such as Tesla forced to cease production. That's also had an impact on Chinese equities. This is the MSCI China Index. It's down more than 25% this year. This includes tech giants such as Tencent, Alibaba and JD.com, alongside the Bank of China and Ping An Insurance. Some analysts say more domestically focused companies may do better than those with greater international exposure, since Chinese policymakers may introduce more domestic stimulus. Well, to find out more on what could be in store for the Chinese economy, I'm now joined by Marcelo Carvalho, Global Head of Emerging Markets Research at BNP Paribas. Marcelo, hello, thanks for coming in. So how much of a hit do you expect the Chinese economy to take from zero COVID in this half of the year?
The COVID situation is a very important headwind for the Chinese economy right now. Let me give you numbers. For the second quarter of the year right now, we had been looking for growth of 4% over a year ago. It now looks it could be about half of that, 2%. For the entire year as a whole, we have already revised down our forecast from 4.9% to 4.5%. Now 4.5 is about 1 percentage point lower than the official goal of 5.5%. Therefore, we estimate that the impact of the COVID situation is about 1 percentage point. We do think, however, that the risks remain biased to the downside. It wouldn't be surprising if, depending on circumstances, growth this year could be even weaker than 4%. The economy should be recovering later on, but that's going to depend on policies to be implemented in coming months.
And that would be my next question. The Communist Party says it's committed to a 5.5% growth target. So what sorts of stimulus measures do you expect it to try and get there?
So first, on the COVID situation itself, it's unlikely that the zero-COVID policy changes dramatically ahead of the Party Congress later this year in October, November. There are, however, other policies, fiscal, monetary and foreign exchange policies that could be implemented. On the fiscal side, for instance, the authorities could accelerate infrastructure spending. On monetary policy, they could ease monetary conditions, which is very interesting because this goes against what's happening pretty much everywhere else in the globe where central banks are hiking interest rates. And finally, on the currency front, it looks like the authorities are more willing to let the currency weaken, maybe to as much as 7 yuan per dollar, as a weaker currency helps to boost the exports of the economy.
The shutdown of factories, especially in the Shanghai era, is of course reducing those exports and blocking up global supply chains. So what impact is this having on inflation globally?
So this is a very important point because the Chinese situation aggravates a global inflation picture which was already quite challenging. We have seen already the supply chain constraints coming from Russia on oil and energy, and China adds to those constraints because China is a very important hub for global supply chains. It's interesting that in China itself, inflation is not so much of a concern right now. Chinese inflation is about 2 percentage points only, which reflects the fact that Chinese growth is not as strong compared to the much stronger growth you see in other parts of the globe, for instance, in the US.
And which emerging markets are seeing the most impact from this? Many countries, of course, are reliant on their relationship with China to sell commodities to Chinese factories, for example.
So for other economies in emerging markets, I think there's good news and bad news. The good news is that there are signs of some decoupling recently from other emerging markets, from China. The reason for that is that commodity prices have been well supported, in part because they reflect supply constraints and also strong demand from the rest of the globe. So that's good news for commodity exporting economies like in Latin America. The bad news, however, is that no one can really escape from a negative impact from Chinese slower growth. And I would think there are two categories here of countries exposed to that impact. First is Asia itself, places like Thailand, for instance, that could suffer from weaker Chinese growth. And across the globe, commodity exporters like Argentina, which exports soybean, or Chile, which exports copper, could suffer as well from slower growth in China.
Thanks so much for that insight, Marcelo Carvalho, Global Head of Emerging Markets Research at BNP Paribas. Well, before I go, here are some of the other stories we're following in this space. China has pledged an all-out effort to support North Korea after the country reported its first ever COVID infections this Thursday. The isolated state sealed its border to block the virus in early 2020 and had never reported a case until now. No North Koreans have been vaccinated against the virus. The border with China was reopened for trade earlier this year, but China has since closed it again because of the virus situation on the Chinese side. Foxconn, the supplier of Apple's China-made products, reported a 5% rise in first quarter profits this morning, largely in line with expectations. The world's largest contact electronics provider had previously said China's lockdowns had little impact on its factories in Shenzhen, but demand for smartphones in China has suffered as people remain shut in. And the risk of major defaults in the Chinese property sector is back after the country's third largest developer by sales, Sunac China, missed an offshore bond payment today. It follows the high-profile difficulties of China Evergrande and comes as COVID lockdowns weigh on property sales, while the weakening yuan, now at a 19-month low against the dollar, makes it hard for developers to meet their offshore obligations. And that's your roundup of China. I'm Elena Casas, and this is Reuters.